Depreciation is a powerful tool for real estate investors. It allows you to save money on your taxes each year. In simple terms, depreciation is the gradual decrease in value of an asset over time. Think of it like a car. A brand new car loses value as soon as you drive it off the lot. This is because of wear and tear, age, and obsolescence. The same concept applies to real estate. Buildings wear down over time. They need repairs and eventually become outdated. The IRS, the tax authority in the United States, recognizes this. That's why they allow real estate investors to deduct a portion of their property's value each year to account for this depreciation. This is a significant benefit for investors, as it reduces their taxable income. It's important to remember that not everything in real estate depreciates. Land, for example, is not considered depreciable. Land is assumed to hold its value or even appreciate over time. Depreciation only applies to the building itself and any improvements made to it. These improvements might include things like a new roof, an addition, or a remodeled kitchen. The IRS has specific rules for how depreciation works in real estate. These rules determine how much you can deduct and for how long. One of the key factors is the useful life of the property. This is the period over which the IRS assumes the asset will be useful for generating income. For residential rental properties, the useful life is set at 27.5 years. This means you can deduct a portion of the building's value each year for 27.5 years. Commercial real estate, on the other hand, has a useful life of 39 years. Keep in mind that these are just the standard useful lives set by the IRS. There are cases where you might be able to use a different useful life, but that's something you'd want to discuss with a tax professional. Another important thing to remember is that depreciation is not a one-time deduction. It's a yearly deduction that you claim over the useful life of the property. This means that you'll need to keep track of your depreciation deductions each year. It also means that you can potentially save a significant amount of money on your taxes over the life of the investment. Calculating depreciation might seem complicated, but it's actually fairly straightforward. The IRS uses a system called the Modified Accelerated Cost Recovery System, or MACRS. Don't let the name intimidate you. MACRS simply provides a formula for calculating your annual depreciation deduction. The first step is to determine the depreciable basis of your property. This is the portion of your property's value that you can depreciate. Remember, you cannot depreciate land, so you'll need to subtract the land value from the total purchase price of your property. Any costs associated with acquiring the property, like closing costs, are also included in the basis. Once you know the depreciable basis, you divide it by the useful life of the property. The result is your annual depreciation deduction. For example, if your depreciable basis is $200,000 and the useful life is 27.5 years, your annual depreciation deduction would be $7,272.73. MACRS is a powerful tool for real estate investors, but it's essential to understand the nuances. One crucial aspect is depreciation recapture. When you sell your property, the IRS wants to recoup some of the depreciation deductions you've taken over the years. This recapture is taxed at a maximum rate of 25%. It's also important to differentiate between improvements and repairs. Improvements, such as adding a new bathroom or replacing the roof, increase the value of your property and have to be depreciated. Repairs, on the other hand, are considered regular maintenance and are fully deductible in the year they are incurred. Finally, remember that if you purchase a property mid-year, you can only claim depreciation for the months you own the property. This is called partial year depreciation. Understanding these aspects of MACRS allows you to maximize your tax savings. Depreciation is a valuable benefit for real estate investors. By understanding how it works, you can make informed decisions about your investments and potentially save thousands of dollars in taxes. If you are considering investing in real estate, it is essential to consult with a qualified tax advisor to understand how depreciation can work for you.